Hello, I'm Donna Sawyer from the Finance News Network, and joining me from Pengana Global Resources Fund is Portfolio Manager Tim Schroders. Tim, welcome to FNN.
Pleasure to be here, Donna.
The Pengana Global Resources Fund offers exposure to a portfolio of globally listed resource sector companies. Why should investors look at including an exposure to global resources as part of a portfolio?
In a portfolio context, resources provide good diversification and can actually lower risk in a balanced portfolio. And whilst it's fashionable at the moment for investors to seek yield at the exclusion of capital appreciation, those trends do change over time, and resources globally are a significant part of the overall economy, and particularly significant in leveraging to emerging economic growth. So they do provide good balancing in an overall portfolio.
So what is your investment philosophy?
Our philosophy is ostensibly the same as many other managers. We're seeking superior returns over a medium-term time frame. However, what we do differently is we use a different investment process, marrying top-down and bottom-up processes in seeking to create a portfolio that's more robust with lower risk, and importantly, uses tools such as shorting capabilities and pairs to mitigate risk and hold on to gains once those gains are secured, as opposed to giving them back with the fluctuations in the market.
Pengana Global Resources Fund has a fairly rigorous selection process. Tell me about your investment strategy and screening process.
Our strategy is really one of making sure that we stick to a disciplined process in assessing investments and valuing them appropriately, but also understanding the changing nature of markets and what investors are rewarding, and that does change significantly through an economic cycle. What we do well is being able to use both long and short components, and also that's very valuable in terms of we get more bang for our buck out of our valuation process. So we're not only trying to pick the best potential returning companies, but we're also able to utilise those that have poor return characteristics by shorting them in our portfolio as we see fit.
So what do you look for when investing in a good resource sector company?
Typically, the generic answer to such a question is low on the cost curve, a tier 1 asset, long life in terms of reserves, and a good balance sheet behind that company, and some sort of product differentiation. In reality, the missing ingredients, the value around that, is it appropriately priced in the market, or is there something else that we seek or see in the value that's not apparent to the rest of the market? Therein lies the challenge in setting a portfolio, that some of those companies have those broad characteristics, but they're either fully priced at some points in the cycle or overpriced, and we can adjust accordingly in terms of being long those stocks, or in fact short if we see there's an opportunity where the market's got overly exuberant in pricing those stocks.
Are there any types of resource sector stocks that the fund won't invest in?
I think we're very cautious in terms of small cap explorers and developers. There is a point in the cycle where you can invest in those, but generally with no cash flow, they're not things that you can value accurately. As a mandated change within the way we structure our portfolios, we don't invest in small capitalised stocks offshore because we don't get the access to management that we do domestically, and we believe management's such a critical factor in investing in that part of the market.
Aside from volatility, what are some of the key risks you're considering right now?
I think the context of risk is important, and what we've seen is excess capacity built up in the global economy up until the global financial crisis. That's taken some time to work through, and we're part the way through that process at the moment. Equity markets have been volatile, resources in particular. China's a significant risk for us in terms of Australia produces 3 key commodity exports, being iron ore, coal and natural gas. Those exports go to 3 key customers in China, Japan and South Korea. It's a very concentrated pool of commodities going to a few customers. Any of those customers have economic woes or hit speed bumps, we're vulnerable. That's why, being a global manager, we have a broader context. We're able to invest in commodities in a broader sense and not be exposed to 2 or 3 key components. and hopefully mitigate against some of those risks which are becoming more apparent day by day.
That leads me to the next question about performance. Pengana Global Resource Fund's objective is to capture strong participation to the upside of global resource market movements while limiting downside exposure. Have you achieved that over the life of the fund?
Since we incepted the fund in March 2007, the fund's average return per annum has exceeded 6%, against a backdrop where our composite index has actually fallen over 4% per annum. So overall, we're very pleased. It would have been nicer to have a little more of a tailwind, admittedly, but generally speaking, the objective of participating in the upside whilst limiting the downside has been achieved, and we're very pleased by that.
Finally, Tim, what are some of the factors that are likely to impact on your performance this year?
I think we're going through different iterations in the market at the moment. Commodity prices have been moving lower. Expectations and blue sky have been priced out of the resources sector, and the yield push or yield at any cost play in the market is coming to an end, and I do see a rotation back into resource stocks during the second half of the year as people become more confident on the US recovery and China's new leaders provide some new economic stimulus, and we're likely to see that sometime in the second half of this year with an urbanisation package announced.
Tim Schroders, thanks for the introduction to Pengana Global Resources Fund.
It's been a great pleasure. Thanks, Donna.